Hey guys, what's happening? This video is on Fibonacci Killer, and don't want to get too in front of my skis on this, but I don't mean to say that Fibonacci is not at times valuable. It could be in cases, but the problem with Fibonacci, it's kind of like a blind monkey, doesn't really see the big picture. And if you used it exclusively as the buy point for pullbacks in a cycle-based trading system like ours, you're going to have a lot of dead zones where the prices just sit there, sometimes for months at a time. So we're not trying to keep money tied up needlessly, and so we want to take a holistic, big picture approach to trading, especially because we're wanting to keep our money working hard. So not to say that Fibonacci is not valuable in places, it's just not holistic. That's probably the best word for it. And I'm going to go through some charts and show you what I mean by that. Also, it really is not good with trade filtering. I mean, what does it do? It identifies areas on a pullback to enter, and sometimes the price projections, the Fibonacci projections, can be decent, but it doesn't take a big picture approach to trading. And whereas the TSS cycles are more what's the word, solid, I guess. For instance, if you trade off the assumption that Fibonacci retracement inside of a cup might be 62.8%, and you're waiting for it to hit that, never hits that, bounces at 50, gets away from you, and sure, you can use price action analysis at those different fibs to make an entry, but there's nothing more solid than the fact that you have a trend line placement based on fractals. Again, once the fractal's set, you have a solid trend line. It's not guessing. It's the same with moving averages. If you were to make an assumption that because a stock is a good quality stock and the hedge funds will drop in and accumulate once it hits the 200 MA, and it never hits the 200 MA, or it overshoots. Again, there's nothing finite about that approach. What's finite is it's always going to give you, generally speaking, 3 trend lines when you have a big move on the left-hand side of a pattern. So once that third trend line sets, that's where you need to be focusing your entry point, because oftentimes your entry point there can be equivalent to maybe a Fibonacci retracement that was 2 months ago. Meanwhile, you're at the same price the Fibonacci entry was, and but you avoided that 2-month dead zone, and you're basically getting in when it's ready to take off again after pulling back from that third cat line set. So again, we're trying to take a holistic approach, and very difficult to do that if you just trade blindly using any individual indicators. So I'm going to go ahead and break down some charts and show you what I mean by this. Make a lot more sense, and it's something I use on every trade I enter. So let's go break down some charts on it. All of the terms you'll see in the charts in the rest of the video are explained in this free guide, 3 Signals Stock Surfing, Secrets of the Stock Market's Biggest Winners. If you haven't read it yet, you can download a free copy using the link below this video. Okay, first one here is Cronos CRO. This is a hot marijuana stock, traded in and out of over the last year, done pretty well on it. This had a big gain on the left-hand side of the pattern, 1.5 BMI, and then Fibonacci retracement down below 76.4. If you do little research on Fibonacci, you'll see that the primary retracements a lot of swing traders use are the 23.6, 38.2, 50, and then the 61.8. But the 76.4 is commonly used a lot in intraday trading of Forex futures, etc. And quite a valid number. And some some traders use a 78.6 also. Either way, it's in the area. I personally tried 76.4 a lot more on intraday stuff and it seemed to work pretty well with me. But the point is that what we're trying to demonstrate with this is that it's not that Fibonacci doesn't work. It's just that if you blindly buy in retracement, let's say your target on a pullback is 76 or 62.8, 61.8, then what happens is when it hits that area, you looking for a reversal when you buy. A lot of times you're going to have 2 to 3 months of dead zone. This one was not too bad. I mean, it months sideways, and then if you got in, the breakout of the base right here, you're in around $8. Whereas if you wait for Cat 3 pullback, so you got Cat 1 here, Cat 2, you actually have 2 internal cat lines also. And so Cat 3 here, this looks to be about a TM2, and a pullback off of that, say you're in a little bit over 10. So yeah, you got a pretty good entry down here as far as price, and you're closer to double there, but you have a 1 month dead zone. A lot of times that 1 month turns into 2 to 3 months, your money is sitting there doing nothing, whereas you can see once it breaks out, it does so very quickly. And again, we want to be continuing to trade in and out of the best stocks, moving right then, and not keeping money sitting needlessly. Now, a lot of traders will wait till it gets up here, but if I can still get down here and not have a lot of time where it's just sitting there doing nothing, took a few weeks to get up here, I'd rather be in down here. I don't really care to be in down here and sitting for months sideways, pops a little bit, comes back. You're 2 months from your entry point, really not much progress. Whereas if you wait for Cat 3 to set up and pull back off of that, you really have no dead zone on that. So I think that demonstrates pretty well the limitations of Fibonacci. Let me show you another chart here. Okay, next one here is CRMD. And this one had a really nice breakout on the left-hand side of its pattern, 8 BMI, vector of 1. Had the left pivot form there in October, and then you got a pullback. So again, if you're blindly trading Fibonacci pullbacks, looking for an entry there, especially inside of Cat 1, you got a lot of dead zone there. So let's say you took the entry Cat 1 based on a 61.8 fib retrace, and you're in it. Pops a little, comes back, 1 month dead time, pops a little, comes back. So yeah, you got to get an entry down there, $1 versus maybe 175 up here. But there's also a chance once this TM1 is set, TM2 is set, pull back in here. This could be an extended consolidation zone down here. So what if that is the case? You get another 1 to 2 months sideways here. You got, if you blindly took the entry in a 61.8, you got 1, 2, 3, potentially 4 or 5 months dead zone. Would I trade this good entry down here, $1 versus 175 if there's just a soft landing pullback? I don't think so. I think I would rather keep my money working quicker and harder. Take this shallow entry here, and you see how quickly it moved over here. So it's possible that this is a soft landing pullback, 1 month trade. Get in and out, roll the money to the next trade. Much better off. Let's look at another one here. Okay, next one here is CVM. Nice breakout, 2018, 4 BMI, vector 1. Set the left pivot, pull back into the cup, and then you get your cat lines forming right there. So let's say you followed the news on this and you learned it was really good news. You knew it had a big run up, and you felt like it would be a soft landing pullback, 38 or 50 fib retrace. Let's say it fell down through 38 and you said, I'm going to buy it when it hits a 50 fib. So let's say you bought there and you're still inside cat line number 1. So you got in there, you got 1 month, 2 months, 3 months sideways, and no guarantee it's not going to set a TSS right there and then head to the south channel or mid channel. So again, a lot of dead time. Yeah, you got a good entry, but again, these things don't follow through that quickly after a big run up like that. There's profit taking selling pressure that oftentimes takes months to work out, and generally through 3 cat lines, 3 cat cycles. And so that's where we're at right now. We basically got cat line number 3, and if in fact get a little bit retest of that back line and it heads out of here, I probably want to be buying this on a break of a 2-month high or so there, just for extra confirmation. But you have your cat 3 set, and so instead of blindly buying a Fibonacci retracement over here and sitting 1, 2, 3 months, you'll wait for cat 3 to set, pull back off of that, and entry that. I mean, it's very possible that soft landing pullback here, you get another similar run as this here. This went a couple 100% very quickly, very fast out of a breakout. So that may in fact happen here, and you avoid all that sideways chop just blindly buying a Fibonacci retracement. Let's take a look at another example here. Okay, next one here is AINSG, and similar situation. Big run up on this, 100% plus gain, and pull back into cup. And this is a soft landing pullback. If you were following the news on, you knew it was going to be a soft landing just because it was just such a good story, and you were looking for a 38 fib or a 50 fib retrace. That's what you got. But let's say you blindly bought a little bit below 38 fib retrace. Again, you got 1 to 2.5 months of dead zone. Whereas if you wait for cat 3 to set, cat 1, cat 2, and you wait for the pullback off of cat 3. So you get your pullback here. Let's say you want to buy an 8 to 10 bar high right there. Again, meat of the move trading. That's what we're about here at the Big Kahuna Trading Club. We're not trying to keep our money languishing unnecessarily. And you can extrapolate this same technique to intraday trading. Again, traders who blindly, let's say on a 2-minute chart, 5-minute chart, whatever, they're buying a Fibonacci retrace and then sitting through a couple 2 to 3 hours of sideways action when they could have been using that money in another index where you have a immediate breakout of a pullback of cat 3, max out the trend, move the money over to the actual one that they got into, and wait for the cat 3 and have a quicker resolution on the trade. So it's just a more efficient way of trading, taking holistic price action analysis. So get your fib set, and again, just blindly buying a Fibonacci retracement pullback, just a recipe for keeping your money not working as hard as it could be. Let's look at another example here. Okay, I had to switch charts. The other platform had a lot of lines, errant lines on it. Could not get rid of them. So this is LIQT, and big run up on that. You get a cat line there. You just have some internal cat lines on this. You got technically you got a cat 1, cat 2, cat 3. So let's go with that there. It looks to be a mid-channel violation too. So you got your mid-channel violation. Again, big run up. Say you blindly bought the Fibonacci retrace 50% retracement. That'd be right here. So you bought it, and then you got to sit through 2 months dead zone doing that. Whereas if you paid attention to the cat lines, sure you have one right there, but you also have internal cat lines. You have 3 internal cat lines inside of that pullback. You got one there. You got one there. So you got number 3, and then a pullback to mid channel right there. You'd have a very good entry right there around 120. So you want to be buying here and getting that quick breakout, or do you want to be buying here and sitting through 2 months of chop just to get your Fibonacci retracement? I think you'd prefer the waiting until that cat 3 pullback inside of that channel. Let's look at one more here. Okay, last one here is AMSC, and similar situation. If you were just blindly wanting to trade the pullback Fibonacci retrace pullback, you see right here we got cat line number 1, that's in July. So cat line number 2 sets up late August. Cat 3 sets up September, October, pulls back inside of that. So if you took a Fibonacci retrace entry at 61.8, you got basically 1, 2, you got 3 months sideways action doing nothing. Whereas if you took the cat 3 pullback, you get a TM2 cycle on that. You got also a looks to be about a TD 3 or 4 cycle on that. Yep. And it's internal, and then you put it across the bottom, and you got pretty much very tight entry on that. And you avoided that 3 months of chop by not blindly trading Fibonacci pullbacks. Now there are some places where Fibonacci pullbacks might make sense. Like after you know that you got a trend starting, breakout, let's say this one right here, I believe AMSC, actually that was in a PBC zone. So right here you got to pull back here, you got to break out of a cup, and you got PBC zone forming, and you know since it broke to a new high, it's probably going to follow through relatively quickly, and you want to get a laser entry in a pullback. This might be a place and way to do it. So you got a nice breakout, $6 to $12 plus, 100% plus gain pretty quickly. Fibonacci retrace, 50%. Very good entry on that if you took the breakout of a 3-bar high after the 50 fib in a PBC zone. This is where PBC zones generally follow through quicker because they're a breakout to a new high and a pullback. So you still don't have a lot of time languishing once you get out of the breakout of the pullback inside of the handle. So right place and a wrong place to use Fibonacci, and inside of a cup after a big gain in the middle of a super cycle versus a late stage super cycle is really not the place to be using Fibonacci. If you would like to test the waters and see what the Big Kahuna Trading Club is all about, I'd encourage you to take advantage of the offer you see below this video. We'd love for you to come check us out, ask questions, and get a better feel for how our system can help you find and trade some of the rogue wave stocks you've seen in this presentation.